So today we will only focus on what exactly is this management accounting, why there is a separate stream for this. Okay, so it is a combination of two terms, which is management and accounting. So what is management? Management is the process of planning, organizing, directing, and controlling the activities. So each subterm has a weightage. Like what is planning? What I will produce, where I will produce, in which timeline I will produce, what resource I require. So all this is a part of planning. Then organizing. Organizing as in what all departments are there, who will report to whom, who's the boss, what is their responsibility, and what will be their accountability. All this is organizing. Directing andre, then you will have to give them their responsibility or goals, what they have to do, what target they have to meet in a current or a future period. Then controlling of all activities means whatever goal you set, and these goals are assigned to various departments, and you are given them timeline, then you control whether it is going in right direction. So that is the part of management in an organization. So example can be like a principal of a school. So principal doesn't go and do the teaching more. What he will do, he will plan academic calendars, then what festival we have to celebrate, which teacher is in shortage, how many hours they should get. So all this is like the management means like a principal. Then accounting. What is accounting? We all know this is a process of first is recording, then summarizing, and then reporting of financial transaction. So recording all happens through your journal entries. Then you will summarize into ledger accounts. Then all of these are reported as financial statements. So an example is a shopkeeper, he will record his sales, what is the purchase in our credit area, if there is a credit purchase or credit sales, how much is the pending. So all these are part of accounting. So management accounting combines principles of management in accounting. So within accounting, what kind of planning I can do? Within accounting, what kind of organizing I can do, or controls I can bring in. So that is the essence of management accounting. It's relatively a new subject. Earlier, there was only one subject, which is recording of cost. Okay, there was no financial, there was no cost accounting, there was no management accounting. From time immemorial, maybe like 16th century. At that time also people used to do a lot of business. They used to do trading. So all that they had to record somewhere, correct? So that was the first stage. What they were doing, they were just plainly recording some of the data and how much it is costing me. At that time, it was more of material oriented. Once industrialization happened, the steam engine was invented, then some advancement happened. At that time, what happened? You had all different types of costing. Then you can plan certain activity. So earlier, a lot of things were dependent on seasons, resources. But once the steam engines and also the assembly line in US, so all of these came. What happened? They could plan certain things in, let's say, 40 hour I will do this. Next 40 hour I will do this. So like this, they could plan and organize. So that is like moving from the first phase to second phase. So during this time, all this standard costing came, because then they were defining this is a standard period. 40 hours a week is my standard period. Actually, it has come from Henry Ford, who was the father of automobile automation. So earlier, cars were assembled, one person used to assemble one car. So he used to take months. What Henry Ford did, he introduced assembly line. That means one person, if he is assembling car seat, the car will come to his station. He will only assemble seat, and then he will send it to next person. So that next person, he will assemble next part. So this type of thing is called assembly line. Once he introduced, Henry Ford, he standardized 40-hour work week. So once time is standardized, they introduced standard costing. Since there were assembly lines, there were stores, so they were all different centers. So accounting centers came into picture. So they were all given different responsibility. Some centers had cost centers, they are called. That means their goal is to minimize cost. Some centers had profit accountability. So they were revenue centers. For example, once this cars goes to the showroom, selling is a profit center or revenue center. So once these money came to them, what they have to do, they have to invest somewhere. So during that time, all your financial management and other concepts, they started coming up. how will I make better use of this capital? Should I invest? If I am investing, in which instrument should I invest? What is the discounting rate? So all this discounting rate you will learn in financial management. It is nothing but what is the return I am getting, because now I have additional money. So I am collecting money from the customer, then I am selling after 2 months. I have money. What do I do with this? I can invest it in somewhere. So this is like the second phase of, you can say, planning and control, which is coming into accounting. After this, the recent ones are analysis, going into the strategy, a top line of from starting to end. How is my supply chain looking? What is my competition doing? With respect to my competition, how can I improve my cost and profitability? So there is strategy. Cost and profitability is your costing. So this is an aspect of management accounting. So that is how management accounting has emerged. So now you are getting why there is a separate stream of management accounting. This is like management and you have accounting. Management accountants. So first you can ask, is there a role called management accountants in an organization? Some companies have, some companies do not have. So they are also called by different names. But in essence, you don't find, okay, I am a management accountant. Like that, you will not find a designation in companies very often. If you go open Naukri or some other job portal and search management accountant, you will still see, but they are not as many as a cost accountant or a financial accountant. So typically these management accountants, they are hired as strategy experts, not as an accountant, but as a strategy person or a consultant. So what do they do? What is their role? Okay, so this I have broken down to some acronym so that it is easy to understand. A, B, C, D, E, F. Okay, A. Advise management about financial implication of a project. So let's say the company, there is a manufacturing company, they want to take one project, which is development of a new product line. So the management accountant, they are well versed with management tools, also accounting. So they will also know strategy aspects, which is competition, customer. So all this they know. So when I'm taking a project, they will advise the management. Management means senior management like CEO, board of directors. All these persons take consultants from management accountants. About what? If I take this project, what is going to happen? How is it going to look like? How much revenue I'll get? Let's say next 3 years. For that, how much investment I will be doing? What is going to be my variable cost? What is going to be my fixed cost? What is my payback period? What is my internal rate of return? So this payback period and internal rate of return, these are mostly financial management topics, but management accountants, they know about this. B is they do budgeting and forecast. So what is budgeting? Budgeting we have already learned in cost accounting. It is for a future, definite future period. And it is represented in monetary terms. Two things are important for a budget. So they do this. For a next future period, what is going to be my monetary terms? Means what is going to be my cost, or what is going to be my revenue, what is going to be my profitability, cash. So all these are aspects of budgeting. Then if there is any deviation during execution, so I had budgeted something, but during the execution, management accountants also track, am I going as per the plan, as per the budget? So that is why usually quarterly reviews happens. In big companies, you have mandatory quarterly disclosures. Even in small companies, they will have to do one check. So that is why this quarterly they close certain accounts and they check with respect to budget, what is that they are doing. And management accountants will do course correction. I mean, they will not do, they will suggest. So what they will suggest? The cost is not as per the budgeted, we are exceeding. So they can advise supply chain or purchase, you look for alternate suppliers or you look for alternate materials. Or they can also say you change the design so that you don't use that much of material. So all these advice comes from them for budget correction. C is cost accounting and control. So cost accounting, usually cost accounts will do. But as a management accountant, he is well versed to read the cost account. He can read a cost sheet and quickly understand what it is. What is the profit and what are different ratios. Then accordingly control. Let's say overhead rate is more. So how to bring it down? Either increase the production so that denominator goes up, or reduce expenses so that numerator comes down. So well versed with all these techniques. Reporting for decision making. So there are certain, in this also you will see in your syllabus, there are certain topics like marginal costing, standard costing, which help in decision making. Whether should I accept or not, should I buy or make. So all these are decision making points. So there are techniques, tools in the management accounting syllabus which will help doing that. Evaluating performance of the company. How the performance is going for the current year. So far, how is it? Is there any change with respect to budget? Again, there are different tools to evaluate performance also. It's not only cost and profitability. So there is earned value management, which is part of your syllabus. So all this will help. Then financial control, interpretation of data, tax accounting. So how to remember this? If they ask, what is the scope of management accountants? That can be the question. So I have summarized as what they do. Basically, this is what they do. How to remember? A, B, C, D, E, F, I, T. Interpretation of data and tax accounting. See, interpretation of data is very, very important. Just as a cost accountant also. As an accountant, interpretation of data is very, very important. So you don't directly get ready-made data. In the companies, you will get one set of data from one department, then another set of data. In isolation, these data do not mean anything. But when you combine and then interpret, then you can make out something. You can see a trend, or you will see a deviation. So that is interpretation of data. Then tax accounting it's a part of your normal accounting only. Like you prepare your income statement, and from income statement you come to know what is your tax. In addition to that, what they do is where they can save tax. So in certain cases, let's say you have finished goods, you can sell it at a loss. It's like it's a sunk cost. Okay, no one is going to buy at the market price. But if you keep it, you are incurring your inventory cost. So they can say, okay, sell it at a loss. So since there is going to be a loss, our profit comes down. Because of that, my tax also will be lower. So they will do this analysis. Which stock I can sell so that my tax comes down, and overall it does not affect my company. So here it talks about what is there, what techniques as a management accounting you will learn. So some of are generic, some techniques are specific. Means if you are a CA student, CMA student, you will learn almost all of this, or even an MBA student will learn all of this, or some of it. So you can classify them as two types. One is traditional techniques. That means, so once the accounting as a practice started, these techniques are already were there. So first is financial statement analysis. So look at the balance sheet or P&L and analyze that. Marginal costing and standard costing, you have already know what it is. So PV ratio analysis is a subset of marginal costing only. Then budgeting and activity-based costing. So activity-based costing, the main difference is to produce, let's say you are in a car manufacturing company. To produce car, typically how you think? You think I need a factory, I need a resource, and the resource are like labor, electricity, and factory time. All these are my resources, and they all have some rates. So I multiply and then I can get my overhead cost. But in activity-based costing, what happens? Instead of resource, what you do, you will identify what activities you need. So same car manufacturing company, you need purchase order placing, that's an activity. Then material handling is an activity. Assembly is an activity. Storage is an activity. So these activity will have some rate. So you multiply that activity time or that activity numbers with the rate. You will get overhead. So this is an alternative to your traditional overhead calculation. This is based on activity. So these are all your traditional techniques. Then there are certain contemporary techniques. One is target costing. So instead of determining what is going to be your cost, you set a target. You start from that cost and then you derive all other things. So that is target costing. Theory of constraints. Flow situation. Flow means assembly line or a factory where all the parts, there is a chain. There is a chain of assembly. So that means there are steps. There will be multiple chains. There are different activities. One is material coming in. Then that material will get into the assembly line. Then they will do some fixing, some assembly. So these process one after the other, this is called as a chain. So there may be multiple parallel chains, but there will be one center, okay, where all of this will be converging. let's take example of storage. So he has to accept from different multiple lines. So there is only one person, but input is from multiple chains. So this person, the storage person, will become a constraint. That means unless you increase his capacity, before him, whoever is producing faster has no effect. So in general terms, that is theory of constraint. I don't think you have it in your syllabus, but it's a very beautiful subject. So I practice it in my day-to-day work, because I am in project management. In project management, there are multiple chains. Even though you don't have theory of constraints, you have similar subject, which is your PERT and critical chain, which is there in your operation and strategy, paper 9. So in the class, I will explain that. What is theory of constraint? Then you have SWOT. It's an acronym: strength, weakness, opportunities, and threat. So that is SWOT. So companies use this technique to find out their position in the market. With respect to my competitor, what is my strength? What is my weakness? And in the market scenario, what are the opportunities and threats? So it's a management tool. Then PEZZLE. Again, this is a MBA concept. PEZZLE also is an acronym for environmental study. Basically, it's a marketing topic. P is political, E is economical, S is social, T I think is technical, L is legal, and again last E is environment. That means when an organization is preparing its strategy, it will look in all these angles: political, environmental, social. For example, I am setting up an IT company in, let's say, Jharkhand. So in this example, political, I will see Jharkhand. How is the political stability there? Is the government good? Is it stable? Is it pro companies? That is my political analysis. Environmental, next. So do I have a conducive environment? Environment is not only the nature, otherwise also. Do I have my supporting workers there? Will I get talent? Then next is social. So will those people accept my company? What do they think about IT company? Because Jharkhand is mostly, they have mining. What do they think about IT company? Then technology. Then legal. Will I have any legal problem if I set up a company there? So all this are parts to the strategy. So that is a PEZZLE analysis. Then you have balanced scorecard, JIT, TQM, value chain analysis. All this are a part of strategy. JIT means just in time. TQM is total quality management. So JIT, TQM are part of your OSM. I think also value chain analysis is part of your OSM. Actually, I get confused since I'm handling both the subject. It comes here, it comes there. So in detail, it is not here. Okay, in detail, all these are on the left side. Whatever you're seeing, traditional technique, these are here in detail. Marginal costing, standard costing, PV ratio, budgeting, all activity-based costing, all these are in this syllabus of paper 12. So let's see how different it is from financial accounting. What is the difference between financial accounting and management accounting, or cost accounting and management accounting? So in order for you to remember it easily, on the left side I've put it in certain heads. How to remember this? ASI and SI. ASI andre assistant superintendent of assistant sub inspector. SI is sub inspector of UP. So ASI, SI of UP. A ಅಂದ್ರೆ application. Why F&A is required? For a true and fair view of financial affairs. So that is their primary goal. Why management accounting is required? To get meaningful data for the management to make decisions. That is their main goal. To assist the management to do decision making. So that is application. Scope of financial accounting. The scope of financial accounting is limited to preparing, organizing, and publishing the financial accounts. Whereas the scope of management accounting is very, very broad. Just before we saw, what is the scope? It ranges from accounting, analysis, and planning, budgeting, forecasting, decision making. All this is in scope of management accounting. The next is interdependence. So financial accounting is the primary accounting in any company. It is not dependent on anything. It just depends on the records. Whereas management accounting depends both on financial and cost account records. Because this is not a primary account. This is a user of these accounts. It uses the accounts, interprets the data, and makes decision. So it will not create any data, but it uses the data which is already done by financial and cost accounting. Next is statutory requirement. So financial accounting is required. It's statutory for certain type of companies. So for all companies, financial account, and also firms as per Companies Act and accounting standards. So you have level 1, 2, 3, 4, non-corporate entities, all that you will learn in your, I think, paper 10 or 11, corporate accounting. Whereas management accounting is not mandatory. It is not statutory. This, if company sees benefit, if I doing management accounting, I can do some value addition, take right decision, they will implement. That is management accounting. It's not statutory. Next head is information type. So in financial accounting, everything is quantitative, means everything has a number. Whereas management accounting is both quantitative and qualitative. So sometimes you will get as a percentage, sometimes you will get as a number, sometimes you will get like a scale. So these are the information types which will come from management accounting. So there will be a graph. So all these are outputs. Then users of financial accounts. It is both internal and external. In external, it can be the investors or it can be the authorities. They will use. Internally, management will use, directors will use, some departments will use. Whereas management account data is used only by management. These are strictly confidential data. It will not go outside, that is first. But even inside also, it is only used by management only. Last, purpose of financial account. So you know, record, classify, analyze, then prepare financial statement. Management account purpose is analyze both financial and non-financial data, interpret the data, then prepare reports for the management to make decisions. So that is the purpose of management accounting. Now under the same head, you will also have the difference between cost account and management account. How different it is from cost accounting? Same heads. ASI, SI of UP. First is application. So application of cost accounting. To know the cost and prevent excess of cost. Means record the cost. Scope of cost accounting, it is cost recording, analyzing and reporting. So management accounting we have already seen under each head. So that is why I am not discussing again management accounting. I am only discussing cost accounting, comparing it with the particular head. Interdependence. So cost accounting is dependent on financial accounts but not dependent on management account. But management account is dependent on both. Statutory requirement. Cost accounts are statutory not for all company but some specified industries as per cost accounting rules. So there is a criteria of turnover and there is a criteria of what product they are manufacturing. So these two criteria is there. So there is a statutory requirement but not for all companies. Management accounting does not have any statutory requirement. Information type, both use quantitative and qualitative data. Then users of cost accounting is management and reporting to central government. So why here I have not told that internal and external, even though central government is external. The main difference is, see, financial data is available in public domain. Let's take an example of any listed company, ITC. You can go to ITC website, you can go to investor presentation and you can still read, even though you are not an investor. So any external person has access to financial record. But cost record is not published anywhere, even for the limited companies. It is only reported to CG. So that is why I have not mentioned as internal and external. Also, it is not internal. All users will have access to cost data. Cost is a very sensitive data. So it is accessible only to management within internally and outside only to your central government and the auditor. Even the auditor is an external entity and not a CG, he has signed an NDA with the company. So that is why auditors also know about this. Whereas management account is not published anywhere. It is kept strictly within only for the management review. Then what is the purpose of cost accounts? Prepare cost sheet, find out the cost, then control the cost. So that is their main purpose. Management account, again, you analyze financial and non-financial data, interpretation of these data, find out meaningful trends, then prepare reports for the management to make decision making. We will see what is the role of management accountants in modern business. Earlier A, B, C, D, E, F, IT. So in detail we will see. In modern business, how do they add value? First is planning and budgeting. So they prepare budgets and they prepare also forecast to guide the business decisions. So they can help sales team, they will help production team. So all the data of planning and budgeting will help material team. All these team can plan their work based on the management accountant's report. Cost management and control. So cost control and cost reduction you already know. So management accountants have a role to play in that. Next one is performance measurement. In organizations, departments or functions will have something called as KPI, key performance indicator. So management accounts, they set up a system to measure these KPIs. Then analyze the KPI and see whether this is sufficient or needs improvement. So all this analysis will be done by them. Then decision support. This is nothing but summarizing all the data, financial and non-financial, and they prepare the report. That report will be suitable for the management. So they know, they understand what the management expects, since they know the aspects of management. And they collect the data from accountants. Since they know accounting part, they collect the right data from the accountant. So with these two combinations, their reports are very easily understandable by the management to make a decision whether I should go ahead with this project or not. If I go ahead, what is my return going to be? Is there a risk? How much risk I am taking? Is there a better alternative? So these are the decisions management will make. So the report of management accountants will help. Risk management. So there are different types of risk: operational risk, financial risk, regulatory risk. So they will identify and quantify. How do you quantify risk? You can ask. It's very risky. It's not risky. So this is a subjective scale. But there is also a quantitative scale for risk management. For example, impact and probability. That is one of the scale. It's called PI number. Probability into impact. So based on this number, they can quantify whether this risk, is it 100%, is it 90% or 80%. And also along with the risk, they will see the reward, because they are doing the business and they have to take risk. Whether this risk is worth taking, how the management will know? Unless it is properly presented by a management account. Next is internal control and compliances. So typically the management accountants will be part of internal control. So they will do internal audits. A management accountant at logistics company designs approval workflow for fuel expense to prevent misuse and ensure compliance with audit standard. So this is a control mechanism. Logistics company, they travel more, correct? So that travel has to be linked with a fuel expense approval. Otherwise, the vehicle is available with the driver. He can use it for his personal work also. So to prevent this, they will introduce one checkpoint. So that is a part of internal control. And sustainability and ESG reporting. So this sustainability and ESG, these are becoming very important these days. So what is sustainability? So sustainability by meaning is to do business over a long term. That's correct. But in the context of business, sustainability means not harming environment. To do the business, I am not harming the environment. Means what is my pollution? How much I am polluting? Air pollution, it's water pollution. Then how much I am recycling? How much I am reusing? So all these are with respect to sustainability. So you can, in your free time, you should explore some listed companies. So I'll give you an example of few, like Tata. Take any Tata listed company, or ITC, L&T, Reliance. You go and see their investor presentation, annual reports. So you will see some para on sustainability and ESG. What they are doing in that, like installing solar panel, going net carbon zero by year 2035. So these are all sustainability initiatives. Why they have to do all this, and how management accountants are involved in this? Because sustainability is how the market views an organization. So there are two companies. One is producing oil. So oil is a polluting industry. And let's say another, there is a EV company or a solar panel company. So solar panel companies for use of renewable energy. So it is helping the society, whereas oil industry is polluting the society. These are the impressions which are there in general public and investors. So when they want to invest, they will go with a sustainable company which is producing solar panel. So that is why every companies, they are trending towards sustainability and ESG. So how much I should invest for sustainability? To improve my, optics in the view of investor and general public, to look good, how much should I invest? So I should install a small pollution control. It will cost, let's say, 2 crore. but because of this, my share price will go up. So this is the type of analysis they will do. Then ESG reporting. ESG is environmental, social, and I think governance. So again, this is also linked with latest requirements, because now companies are going global, or globe is a marketplace now. I can sell from here to Europe or USA. So how are the investors seeing here? See, I see pollution outside. For me, it's a day-to-day affair. For me, it may be okay. But a global investor comes and see, he doesn't like it. He's like, this is not a, I don't want to work with this person. So that is why this ESG has come into picture. So they prioritize environmental, social, and governance issues, and benchmark with the best companies of the world, and they frame policies based on that. These are not directly related to your accounts and all, but overall, this is how the impression of investor matters. Then technology and data analytics, last point. So they will know how to use ERP systems, Excel, Power BI, Tableau. So your ERP system is where you record all the data. So you can view there, but you cannot understand anything. You can extract the data to Excel. Again, in the Excel, it will be tables only. You will not be able to understand anything. But Power BI and Tableau are data analysis tools. You can do certain data analysis in Excel also. To an extent, day to day, my work gets done in Excel only. But if the data is huge, like 1 million data points, you'll not be able to do Excel. So then you have to go to tools like Power BI and Tableau. So this is all about what is management accounting, what they do, how is it different from financial and cost accounting. All you learned in this introduction. So I've added this table also. This is just for your reference. So if there is no designation called management accountant in many organizations, is there a governing body who will issue? Like CA issues chartered accountants. So there is ICAI. Similarly, CMA is there for cost accountants in India. How is it globally? So this is the table. In USA, you have CMA USA. Okay. So certified management accountant. It's not cost and management accountant there. Certified management accountant. It is issued by Institute of Management Accountants. Then in India, we have a single body, ICMAI, for cost and management accountants of India. Earlier, we had ICWAI, and they have changed it to ICMAI. But still, as per the Act of Parliament, it is still Institute of Cost Accountants of India only. Okay. Cost and Management Accountants of India, even though it appears in the logo. Then in UK, you have CMA. So, Certified Institute of Management Accountants. In your study material, you might have seen so many times CMA definition of this. So, this is where the management accounting originated from UK. Because UK is where all the industrialization, all this science took a forward step faster. So, there was a need to do all this accounting and management. So, all this originated from Europe only, majorly Britain. So that is why our study material has reference to CIMA, because CIMA is a very old institute, very well established. So this is Chartered Institute of Management Accountants. Then you also have CGMA, Chartered Global Management Accountant. Then in Australia you have Certified Practicing Accountants. So even though it doesn't say management, there is a separate stream for management accountant in CPA. So this is how each country or different part of the world certify management accountants. In India, it is good. You do CMA. You are good as a cost accountant. You are also good as management accountant, because your syllabus is like that. Half of your syllabus is cost related or financial related. Half of your syllabus is management related.